Well, 2024 is all about the landing. That's according to our next guest. So what is the economy on track for? A soft or hard landing? Well, the consumer appears optimistic. University of Michigan's consumer sentiment report showing a 13% jump in January. Americans are feeling better about the economy, the outlook for inflation and wages. This comes despite the CPI report we got last week proving higher prices are stickier than expected. Joining us now is Paul Gruenwald, S&P Global Ratings Global Chief Economist. Paul, good to talk to you this morning. We talked about the CPI data. We're expecting the PCE data next week, which is, of course, the Fed's preferred gauge. How are you looking at how quickly inflation is likely to pull back, what that ultimately means for the Fed?
Right. Well, thanks for having me on the show. First, you're right. We're watching the inflation very closely and how that's going to have an impact on the rate decision of the Fed and other central banks. We really try to split it out. There's the obvious split between the core and the non-core, but even within the so-called core inflation, we're paying a lot of attention to services, and that's really been pretty sticky. That's a function of what you just mentioned, which is the strong consumer spending, the strong labor market. So if that number doesn't come down, I think that's going to lead the Fed and other central banks maybe to pause a bit longer. But we're in a data-dependent world, so we'll see how those numbers come out next week.
Indeed, it is hard to sort of nail it down when you're trying to look for some consistent data here. We saw Chicago Fed President Austin Goolsbee saying that if inflation progress reverses, that could merit hikes, something that I'm sure investors weren't hoping to see. But they also want to see more progress on housing inflation. What are going to be the key signals to watch as we go from month to month versus really taking a longer view when we're trying to look at this inflation picture?
Yeah, you're exactly right. The numbers have been volatile, both on the real side and the financial side recently. And again, the Fed's going to focus on its mandate, which is 2% core inflation using the PCE. Housing is one of the clear components on that. You would think that with higher rates, housing would slow or housing price pressures would slow, but that's been kind of a mixed bag as well. And then, I think we want to look at the kind of the longer view, not just the month to month, but they're looking at a clear trend. And the Fed's been pretty clear that they want to see a decisive downward trend in inflation in the numbers that they're watching. And again, core PCE inflation and core services inflation still close to 4%. So we're a long way from the target of 2. And again, we think that the Fed is going to be pretty cautious in lowering rates unless we get a significant downturn in the economy. But with a strong labor market, strong services spending and growth, looks like it's printing again above potential in the fourth quarter. That to us says that they're going to be going slower.
Paul, you mentioned housing as one factor you're watching. Obviously, so much of this is also about the inventory story. It's not necessarily about the rates coming down and consumers just jumping in and seeing sort of a friendlier market, if you will. I mean, that sort of begs the question, how much of what we're seeing in inflation, that last mile, if you will, is in the Fed's control right now?
Yeah, well, the last mile is an interesting issue, right? Because to us, you have to talk about the last mile in the context of what's happening in the real economy and what's happening to demand. So again, if the labor market remains robust and consumer spending remains robust, that last mile is going to be difficult to bring inflation down to the medium-term target of 2. If we get a sharp downturn in employment and a sharp downturn in demand and consumer spending, then the last mile is going to be less difficult. So again, our baseline is this soft landing with continued strength in consumer spending and labor markets. But if we go into the risk scenario with a sharper downturn, then the last mile is going to be less of an issue, and you'll see central banks cut more aggressively.
And so, Paul, when you look at how much of the Fed's medicine has already taken hold, the IMF estimates about 75% of that has now reflected in the economy. Do you agree with that estimation? And what are some of the data points that you're looking at that'll really give you an indication of where the economy is headed?
Yeah, well, the U.S. has what we would call a slow monetary transmission mechanism. So we have a lot of fixed rates in this economy, not just mortgages, but some of the commercial real estates and other things that will be maturing over time. But, this pass-through of monetary policy to the real economy is kind of slow in the U.S. So if you look at the U.S. Versus Europe, for example, where the ECB has been very clear that their transmission works faster and their economy is slowing sooner. I think that's a real issue, and the Fed's very aware of this. They move the policy rate, and they wait to see how the financial conditions respond. That's a relatively slow a sort of a mechanism in the U.S. So again, I think that's another piece of the puzzle that the Fed's going to take its time in lowering rates.